There's been a lot of forecasting lately by some of the major banks here in Australia about what they think property prices are going to do over the next 2 years. And after all, it makes sense for them to do this because they're heavily vested in it. And after reading through some of the articles, I thought it might be valuable for you guys if I summarize the key points and also share my thoughts on what I think property prices might do over the next 12 to 24 months. After all, you guys always seem interested in the property discussion, and that's probably because for most people, their property is their biggest asset. So it makes sense to want to know what's happening. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today, we're doing a little bit of forecasting on the Australian property market. These tables are two sets of predictions, one from the ANZ and one from CBA, and the graphs illustrate their property price predictions right up until 2023. As you can see, Hobart and Sydney are the real standout performers this year, given that the Sydney housing market was already expensive before the latest property boom. It's quite an amazing result. Next year, in 2022, it's estimated that prices in capital cities will still rise across all states and territories. ANZ have an estimated average of a 6% rise across the board, and CBA are slightly more bullish than that at roughly 7% across the board. Now, this is a significant slowdown from what we've just been through, but it's still not bad. And finally, in 2023, both ANZ and CBA are predicting that house prices will start to fall. ANZ is estimating an average decline of 4% across major capital cities, and CBA is significantly more bearish than that at a 10% decline. So, how realistic are these forecasts, and should you be putting any emphasis on them when making a financial decision for yourself regarding property? Well, unfortunately, the nature with any forecast is that it doesn't factor in unknowns, because obviously unknowns can't be known. And it's normally the unknowns that really hit us the hardest. So think the global pandemic. And with also any forecast, it is good to keep them in mind, but you don't let them dictate 100% of your financial decision making, because at the end of the day, the decision is about you and your situation. And a lot of the time that has nothing to do with external factors. But that still leaves the question, do I think these forecasts are reasonable given what we know today? And the short answer to that is yes. When looking at the primary forces behind property prices moving forward, you have to put interest rates front and center. A rise in interest rates means that the cost of borrowing has increased. And the way I like to look at this is when you own a house, but you still have a mortgage against it, think of it like you're renting off the bank. The amount of rent you pay is equal to the interest component on your regular repayment, because that's your cost of borrowing. And while interest rates are so low, it means that as a homeowner, your rent's very low. But if interest rates start to rise, it's going to be the equivalent of getting a rent rise. So a higher interest rate would mean that people can borrow less, which is obviously going to slow demand for property. Also, for those people that are already in the market, and particularly those people that are very heavily leveraged and probably borrowed a little bit more than they should, an increase in interest rates might mean that they want to sell their property, and that's also going to increase supply of property on the market. So both a reduction in demand and an increase in supply are deflationary for house prices, and a rise in interest rates could lead to both. However, how likely is it that an interest rate rise is going to occur? Well, we've already seen fixed rates start to rise, and the reason fixed rates are rising is because fixed rates are linked to the bond market. And at the moment, investors are a little bit worried about inflation, and therefore they're selling out of bonds, pushing up the yield for the bonds, and so the market has essentially already factored in a couple of rate rises. But with regards to the official cash rate, the cash rate that's set by the RBA, Philip Lowe, who is the head of the RBA, is still playing it fairly cool. So at this stage, he has conceded that a rate rise might occur towards the end of 2023, but he still sees 2024 as a more realistic time frame for increasing interest rates. So who's right? Is it the bond market that is already factoring in a rate rise due to inflation? Or is it Philip Lowe from the RBA, who basically says that rates probably won't rise until 2024 because he wants to see some growth in wages first? Well, unfortunately, I don't know the answer to that question, but when I done my wrap-up video last year about what I learned in 2020, I did say that it's very risky business betting against the government and the central banks. But the key takeaway from this is that as an investor, be very careful about betting against governments and the central banks. There are obviously other factors dampening the outlook for property prices in the coming 2 years. And one of those factors at the moment is regulation. With property prices skyrocketing this year, APRA is very concerned about affordability. They still want the average Australian to be able to own their own home. So to counter this, we've already seen an additional buffer put on serviceability levels, increasing it from 2.5 to 3%. And there is talk about further interventions such as limiting debt to income ratios. And obviously further intervention in this area will slow down the demand for property because people can't borrow as much. And finally, we're also starting to see an increase in listings, particularly in Sydney. And obviously an increase in listings means an increase in supply, which puts downward pressure on prices. Now, this increase in listings really appears to be people speculating that property prices will fall, so they're trying to get ahead of the curve. And at the end of the day, whether or not they're right about property prices falling or not, if enough people believe the same thing, then inevitably it will push prices down because it's going to increase supply. But obviously there are different property markets across Australia. So there's differences between the states and territories, and there's also differences within each state. And there's always going to be those rare earth properties, those properties that are sitting on a piece of land that just doesn't exist anywhere else. So think, land close to the CBD, close to water, close to the ocean, all that kind of stuff. All those rare earth properties, they're always gonna have some value associated with it. So for me, one thing that I think is very important before going into any property is having a look at the land and where it's situated and asking yourself, is that a scarce piece of land? So there's a lot to consider there. I'm definitely not as bullish on property over the next couple of years as I was at the start of this year. But at the end of the day, you shouldn't let forecasts dictate your property purchase intentions. For me, property is a very expensive asset class to buy. It's a very expensive asset class to sell. So it's something that you go into with a long-term intention. And so worrying too much about short-term fluctuations in the property market may not be the smartest idea. Base your property purchase decision on your financial situation and when it suits you. But that's it for me today, guys. Thanks a lot for watching. If you like this video, please give it a thumbs up and I will see you guys in the next one.